Hi everyone, welcome to Edupedia World. I am C. Radhika Singhal. In the last session, we were already discussing that working capital policy is very critical policy for the organization because that affects the profitability and the risk taken in the organization. We already discussed regarding cash management policy. Today we are going to discuss regarding inventory management and debtors management. Why inventory management is important? So, when a company procures inventory, cash is invested into that procurement of raw material. That raw material is holded for a period until unless it is converted into finished goods or it is converted into WIP stage. But apart from that, when a company procures a raw material, there is certain cost involved in it because when a company procures a raw material, it has to store that raw material. Moreover, there is also a cost in bringing that raw material from the purchaser or to the supplier to the godown. Whatever holding period that a stock has been kept, for that period, the funds have been blocked in the organization. So, inventory management objective is to keep an optimum level of inventory so that the cost associated with all these components is lowest. When a company procures an inventory, the major objective is to keep and maintain that inventory in a usable condition. So that will include the storage cost, that is the cost of storing the inventory in rented premises, or you can say the opportunity cost of storing in our own premises, plus the wage cost of personnel which is assigned to store and secure it, and apart from that, the cost of utilities and insurance for the inventory and the cost of financing. These costs are called as carrying cost of the inventory. Right? Now, to procure an inventory, there is also a cost associated with placing each individual order for the supply of raw material, or you can say raw material, store, packing material. So, if you procure all these in small lots, so there are number of orders. Due to increase in number of orders, the cost per unit of inventory would be more. Right? This is called as ordering cost of an inventory. That what is the per order cost of an inventory? The per order cost is also relevant because you cannot order the inventory in bulk because with increase in that because you will reduce the ordering cost, but that will in case increase the carrying cost because there is a direct relationship between carrying cost. The carrying cost will increase. And the next, if the inventory is not available with the management, and in such circumstances, the company has to procure the inventory on an immediate basis, and that will obviously cost more than the regular supply. That is called as stockout cost. So, inventory management involves three elements. One is carrying cost, the other is ordering cost, and the third one is stockout cost. So the company management, they take certain decision that how this inventory cost can be controlled. Now this can be controlled by various means. Like the company could enter into a long-term arrangement with any supplier to provide a raw material at a certain cost, which is obviously lower than the market available cost. Or the company could arrange a direct supply of raw material at a manufacturing entity, so that will reduce the cost from bringing the material from godown to the manufacturing location and also the storage cost at the godown. Company could also start promoting ex-factory sales of the finished goods. And apart from these, there are various techniques. So with this techniques of inventory model, if you could recollect, there's one model while you studied inventory management or material cost at the executive level. Yes, EOQ model. We discussed about that in the previous class also. So let's just have a quickly brush up that what exactly economic order quantity model was. Economic order quantity model, it assumes that you know that how much inventory you require in the whole year. It also assumes that a per transaction cost of every order is same. And the optimum point is where the relevant cost, the carrying cost, is equal to the transaction cost. So EOQ model enables the company to determine the order size that will minimize the total inventory cost. EOQ is model determines that optimum level, which is the minimum level of inventory. It also determines that at what level the next order should be placed. So it also determines the reorder level for the company. The EOQ could be computed as under root of 2AB divided by C. So what is 2AB? A is the total annual requirement of the firm. B stands for ordering cost per order of that item. Remember, it's ordering cost per order divided by the carrying cost per unit per annum. So EOQ is equal to twice of total annual requirement of the firm multiplied by ordering cost per order of that firm divided by the carrying cost per unit per annum into whole under root of that amount. So if I explain that EOQ is only achieved when the transaction cost is equal to the carrying cost. So the point at which the transaction cost is equal to annual carrying cost, that point is considered as an optimal transaction size. So it's always assumed that the carrying cost is always half of the ordering cost. So if the order units consist of 50,000 units, the annual carrying cost will be considered on 25,000 units. So diagrammatically, the example will be same. Like in the last class we discussed regarding cash management. So instead of cash, it's inventory. The Baumol models and this EOQ model are completely same. The assumptions are also same. It's only that in the Baumol model, we computed the annual requirement of the cash, the optimal cash which the company should keep. And the EOQ model, it's the optimal transaction size of the goods that should be kept into the business. And at what level a reorder or next order should be placed. So we are not doing any example because that's the same example. Instead of the cash, goods will be written. So without any wasting any time, the examples were quite similar. And we are not going to do any illustration over it. Moreover, this is a concept which we already started at the executive level. Next is ABC analysis. ABC analysis is also a system or an analysis which divides the whole inventory into three categories. Category A, Category B and Category C. The division of these categories is based on their value and volume into the company. As per this analysis, the whole inventory in an organization is divided basis their amount or volume and their value. So it is generally observed that nearby 10% of the total inventory, which though 10% of the total inventory, which those is a very small amount, but the investment in those inventory is highest. Such types of inventories are considered as an A category one. The next is B category, which are relatively less important as compared to A category. Means they are not stands that much of value, and even the quantity and the volume of the inventory is more than A category. However, the total investment would be less than A category. And the last is the C category, which value wise is just 10% of the total inventory cost, but volume wise is 70% of the total items handled in the stores. To explain this further, if you say that there are 6 items in an organization, so item 1 is there are 400 units, 2 are of 600 units, item 3000, likewise 4, 5, 6. So in total there are 10,000 items in the organization. So item 1 is just 4% of the total inventory if I just consider from volume wise. But if you go for the cost, item A will cost 50 rupees per unit, B will cost 40, and C, D, E, F like the other items will consider as 14, 10, 2 and 1.1. So basis which if I compute, item A will cost 20,000 B 24,000, 3 item number 3 14,000, 4 12,000. So the company has 10,000 units and the total inventory cost is 80,000. So though the cost is 80,000, item number 1 is 25% of the total inventory cost into the organization. Item number 2 is 30%. So we computed for 3, 4, 5 and 6 also. So you observe that item number 1 and 2, they just have 10% of total stake in the organization, but consist of 55% of the total cost of inventory. Such items are considered as A category. And the next item number 3 and 2, they are relatively more in number, but their value and the percentage of total cost is less than A category items. Thus item number 3 and 4 are considered as B category inventory. And item number 5 and 6, these are unit wise and the volume wise, they constitute of 40 and 28%. So you get 68% of total volume of inventory consists of item number 5 and 6, but their total value in inventory is only 7% and 5.5%. Why this analysis has been done? This analysis has been done because item number A will require more storage and item number C will require less importance as compared to item category A items, because they does not have that much value. So though they are in volume, but since the as per cost or per unit cost is so low as compared to item A category, that it do not require that much cost to be incurred. So item A will be handled more carefully as compared to item category C, right? So these categories shows the level of priority they have. This is about ABC analysis. Now let's discuss regarding debtors management, or you can say receivables management. Receivables, they are near the terminating point of the operating cycle. When a raw material has been converted into a finished goods, the final product is sold by the firm. The sale could be in the form of cash, or company could have sold those items on credit. The extent of credit sales, it varies from industry to industry, and within an industry it also depends basis its position. Say if a company has a monopoly position, it could reduce or it could give a very minimal credit period to its customer. But if there is a very competitive condition for an industry or for a company, the company has to give a credit period as compared to its competitors so that it does not lose its customer. So credit policy has a very significant influence on the sales. The more liberal the credit policy of an organization, the more customers will be happy and the more customers will be attracted to it. But on the other hand, it also enhances the risk over the company, and it also increases the cost because the company cash has not yet been recovered. Because there is an opportunity cost which is involved in the amount involved in the form of accounts receivable. So that amount has been blocked in the form of AR instead of getting invested and giving certain return to the company. So a company has to be very cautious regarding maintaining a balance between promoting of the sales and maintaining the level of receivables within manageable limits. So because of keeping the credit period, what will happen if the company enhances credit period? If the company increases credit period, there is an increase in bad debt loss also. Moreover, since the funds of the company are blocked for a longer period, there is also an increase in the opportunity cost because of increase in investment in the debtors. Other than that, there could also be increase in the fixed cost, or you can say that if you have enhanced the credit period, there could be a delinquency cost is there, or you have to collect, so there is a collection cost also. But why the company increases credit period, there are benefits also that will increase the contribution on account of increase in sales. And since you give a prolonged period to the customer, it might also reduce the collection cost, because after that certain period the customer may return back the amount themselves. So there is also a decrease in the delinquency cost also. So all these costs are being analyzed by a company management to take a decision whether the company should loosen its credit period or should strict its credit period. Which credit period is more beneficial for the company? The cost, the incremental cost, and this incremental gain is taken into consideration. Let's do an example, and that will explain you more that how credit policy is being evaluated in an organization. H Limited has a present annual sales level of 10,000 units at rupees 300 per unit. So 10,000 units are sold at 300 per unit. The variable cost is rupees 200 per unit. That means the contribution is 100 rupees per unit. And the fixed cost amount to rupees 3 lakh per annum. What is okay? So the present credit policy allowed by the company is 1 month. At present, the company is allowing a credit period of 1 month. The company is considering proposal to increase the credit period to 2 months or 3 months and has made the following estimate. If the company increase its credit period from 1 month to 2 months, there is an increase in sale of 15%. But there is also a chances of increase in bad debts from 1% to 3%. That is, there is a 2% increase in the bad debts on the total sales value. If the company go for 3 months, then though there is an increase of sales of 30%, but there is also an increase of chances of bad debt, which is 5%. Apart from that, there will be increase in fixed cost by rupees 50,000 on account of increase in minimum sales beyond 25% of present level. That means if the company gonna increase its credit period by 3 months, there will be also an increase of 50,000 rupees in its fixed cost. Now, why this is so? Because the company might have to include more storage cost. So all these things, more rent has to be paid. So this may increase the fixed cost. So it's not like that the company could only increase its sales beyond level and there is no enhancement in the fixed cost. It depends upon situation to situation. The company plans on a pre-tax return of 20% of investment in receivables. Now, what does this signify? This means that if the company has not invested into receivables, the company could earn 20% by investing. So this 20% indicates the opportunity cost to the company, which the company has foregone due to investment in receivables. You are required to calculate the most paying credit policy for the company. So the most paying credit policy is the one where there's a positive impact. That means that the sales have been increased that much, the contribution from the sales has been increased or more than the corresponding increase in expenses. So if you evaluate, the first thing is increase in bad debts. So existing is there are 1% bad debts. So at sale level of 10,000 units, the company is able to sell 30 lakh rupees. If the company enhances its credit period 2 months, there will be an increase in sale units. So for 2 months, it will be 11,500 units that the company is able to sold, which gives a revenue of 34 lakh 50,000. And in proposal 2, which is like company is able to increase its sale by 30%, that is 13,000 units. The total revenue earned by the company is 39 lakh rupees. Company is already incurring 1% bad debt. That means there is already a bad debt loss of 30,000. Enhancing these sales by 15% would also increase the bad debt by 3%. So at 15%, how much is the bad debt loss? 1,03,500. This implies that there is an incremental bad debt loss of 73,500, which is 1,03,500 less 30,000, because 30,000 they are already incurring. It's because of the enhancement or increase in the credit policy which increase the bad debt loss to 1,03,500. So there is an increase of 73,500. And if the company increases its credit policy by 3 months, there is an increase in the bad debt loss of 1,95,000. So if we compare it with the existing policy, there is an incremental bad debt loss of 1,65,000. Correct. Next is to compute the opportunity cost because of that investment in debtor. It's already mentioned in the question that the company would earn 20% if on account of what is the opportunity cost of debtors. So this can be computed by two methods. One is total cost approach. The other one is marginal cost approach. So total cost approach, we take both the investment in fixed cost and variable cost to compute it. And in marginal cost approach, we take the variable cost and only the incremental fixed cost to compute the opportunity cost. I'll explain you. First, we compute that the same by total cost approach. So if I have to compute incremental, what is the total cost that a company has incurred? Total cost is the variable plus fixed cost. Company is already incurring 20 lakh rupees and 3 lakh is the fixed cost. So the total cost to sales to the company is 23 lakhs at 10,000 units. At 11,500 units, the variable cost will be 200 units, 200 rupees per unit, and a fixed cost of 3 lakh. So the total cost to sales in such a scenario will be 26 lakhs. If the company extends it to 3 months credit period, variable cost will be computed on 13,000 units. And also it is mentioned in the question that the fixed cost will increase by 50,000. So the total fixed cost by extending it to 2 months will be 3,50,000. The total cost to sales will be 23 lakh, 26 lakh and 29 lakh 50,000. Right? Now the average collection period in all these scenarios will be 1 month, 2 month and 3 month. This means that for 1 month, 23 lakhs would remain blocked. 23 lakhs is for 12 months. So how much is the 1 month investment? So 23 lakh is for 12. So 1 month it will be 1,91,667, which is 23 lakh into 1 divided by 12. In proposal 1, it will be 26 lakh. 26 lakh is for 12 months. So for 2 months, if that investment will remain blocked in the organization, the average investment in debtors will be 4,33,333. Likewise, in proposal 2, the average investment in debtors will be 29,50,000 into 3 by 12, which is 7,37,500. Because of this investment, 1,91,000, now I'm jumping into existing one. 1,91,667 is invested in debtors. What is the loss or the return that the company has to forgone? What is the opportunity cost? It is 20% of the investment amount in debtors. So the opportunity cost will be 20% of 1,91,667, which is 38,333. So if I go for 2 months, it is 4,33,333 into 20%, which is equal to 86,667. And in proposal 2, it would come up to 1,47,500. So existing, the company is already foregoing 38,333. In proposal 1, the company is foregoing 86,667. So there is an incremental cost of 48,334. And proposal 2, there is an incremental cost of 1,09,167. This is how to compute the incremental cost using total cost approach, because I am taking the total of variable and fixed cost. Fixed cost is taken in total, not the incremental, because I am taking the complete 3 lakh rupees. In proposal 1 also, in proposal 2 there is a 50,000 increase, but I am not taking the whole 3,50,000. If I have to compute the same incremental cost of opportunity using marginal cost approach, I would take the total variable cost, which is 20, 23 lakhs and 26 lakhs. The fixed cost will be 3 lakh already existing is there. Proposal 2 it's 3 lakh and proposal 3 it will be 3,50,000. So only in proposal 2 there is an increase of 50,000 fixed cost. So when I'm going to compute the average investment in debtors, I would take it as 20 lakhs because 3 lakh is already being increased. 20 on the investment of the variable cost only. What is 20 cost lakhs is for 1 month. So it's for 12 months. So the average investment in variable 1 and the fixed cost is same. So I'm not taking fixed cost. So it will be 20 lakh into 1 by 12, which is 1,66,667. Proposal 1, since there is no enhancement in fixed cost, it will be 0. Variable cost is 23 lakh. So it will be 23 lakh into 2 by 12, which is 3,83,333. In proposal 2, where the company will extend its credit period to 3 months, the variable cost is 26 lakhs, plus there is also an incremental fixed cost of 50,000. So 26 lakhs plus 50,000, which is 26 lakh 50,000 into 3 by 12, 6,62,500. Now we will compute 20% of each under each proposal, and hence the incremental cost of opportunity could be computed. This is how marginal cost approach has been used. So if I have to evaluate both the proposals, we have already computed incremental cost, that is bad debts 1 and the incremental cost, which sums up to 1,21,834 in 2 months credit policy, and for 3 months credit policy it will be 3,24,167. In 2 months, what is the incremental gain? There is an increase in the contribution per unit. From 10,000 units, we'll jump on to 11,500 units. So there is an increase of 1,500 unit sale. Due to that increase, there is a 100 per unit contribution which is adding into the company, which is sum up to 1,50,000 incremental gain. And in 3 months, there is 300 units which is increased due to loosening of the credit period and giving you a contribution of 100 rupees per unit. So that will give you a increase in the contribution of 3 lakh rupees. So when you compare the incremental gain and incremental cost under both the proposals, proposal 1, there is a gain of 28,166 due to loosening of this credit period, and in proposal 2, there is a loss of 24,167. So you can evaluate that extending of the credit policy for 2 months is beneficial for the company, right? Thank you so much. That's all for today. Tomorrow we're going to discuss this topic further.